Imagine a room full of the smartest financial minds on the planet. Harvard MBAs, Wall Street veterans, people who eat, sleep, and breathe the stock market. They have supercomputers, insider research teams, and decades of experience. Now imagine you, sitting at home in your pajamas, sipping tea, checking your phone once a month. No research, no stress, no fancy software. Here's the punchline. Over any 15-year period, more than 90% of those professional fund managers, with all their resources, all their brains, all their experience, failed to beat a simple, boring index fund. 90%. Let that sink in. Hey, welcome back to Finoodle, where finance gets simple. Today we're going to break down what an index fund actually is, how it works under the hood, why it beats the pros, and exactly how you can start investing in one, even if you've never bought a single stock in your life. This might be the most important financial video you ever watch. No exaggeration. Let's get into it. Let's start with the obvious approach. You want to invest, so you try to pick the best stocks. You look at thousands of companies. Some went up 40% last year. Some went down 60%. Some went to the moon. Some went to zero. So you pick one. It does okay. You pick another. It tanks. Another one barely moves. At the end of the year, you've spent hundreds of hours researching, stressing, checking your phone every 10 minutes, and your total return is negative 12%. And here's the thing. Even the professionals don't do much better. That fund manager in an expensive suit with a Bloomberg terminal, he returned 4%. Sounds okay, right? Except the overall market, the S&P 500, returned 11% that same year. He underperformed the market by 7 percentage points, and he charged you a fee for the privilege. So here's the question that changed investing forever. What if, instead of trying to pick the winning stocks, which even the experts can't do consistently, you just bought all of them? What if instead of looking for the needle in the haystack, you simply bought the entire haystack? That's the idea behind an index fund, and it was considered a radical, almost crazy idea when it was first invented. The year was 1975. A man named John Bogle had a simple but revolutionary idea. He founded a company called Vanguard and created the world's first index fund available to regular people. His pitch was simple. Most fund managers can't beat the market. So why pay them huge fees to try? Why not just create a fund that matches the market automatically and charge almost nothing? Wall Street laughed at him. They literally called it Bogle's folly. Critics said it was un-American. They said it was a recipe for mediocrity. Fast forward to today. Index funds hold over $11 trillion worldwide. 11 trillion. They went from being laughed at to becoming the single most popular investment vehicle on the planet. John Bogle didn't just create a product. He started a revolution that transferred billions of dollars in wealth from Wall Street's pockets back to ordinary investors. Bogle passed away in 2019, but his philosophy lives on in one of his most famous quotes. Don't look for the needle in the haystack. Just buy the haystack. So now let's understand exactly how this haystack works. First, let's understand what an index is. We touched on this in episode 2, but let's go deeper. An index is just a list of stocks designed to represent a piece of the market. The most famous one is the S&P 500, a list of the 500 largest publicly traded companies in the United States, ranked and weighted by their size. Now, an index fund is simply a fund that buys every stock in that list in the exact same proportions. So when you buy a share of an S&P 500 index fund, your money is automatically spread across all 500 companies. Apple, Microsoft, Amazon, Google, Johnson & Johnson, Visa, Coca-Cola. All of them. One purchase. 500 companies. Instant diversification. This is very different from an actively managed fund, where a human fund manager decides which stocks to buy and sell, trying to outsmart the market. An active manager charges you 1 to 2% of your money per year for that service. An index fund, it just copies the list. No human judgment involved. It's run by an algorithm. And because there's no expensive team of analysts to pay, the fees are insanely low, sometimes as little as 0.03%. That's 3 cents for every $100 invested per year. Here's what happens mechanically. When you invest $1,000 into an S&P 500 index fund, your money gets split across all 500 companies based on their weight in the index. The biggest companies get the biggest share. As stock prices change, the fund automatically adjusts. to stay in line with the index. If a company grows and becomes more important, it gets a bigger slice. If a company shrinks or gets removed entirely, the fund drops it. All of this happens automatically. You don't lift a finger. And here's the beauty of diversification in action. Let's say one of the 500 companies in the index goes bankrupt, completely to zero. How much does that affect your total portfolio? Almost nothing, maybe 0.2%. You'd barely notice. But if you had all your money in just 3 stocks, and one of them went to zero, you just lost a third of everything. This is why diversification isn't just nice to have, it's your armor. So we know index funds are simple, but simple doesn't always mean better, right? Let me give you 4 concrete reasons why index funds consistently outperform most other investment strategies. Reason 1, fees. This is the silent killer of investment returns. Let's say both a managed fund and an index fund earn the same 10% gross return. The managed fund charges 1.5%. The index fund charges 0.05%. Sounds like a tiny difference, right? Watch what happens over 30 years with a $10,000 investment. The index fund grows to over $172,000. The active fund, only $96,000. That 1.45% fee difference cost you over $76,000. That's not a rounding error. That's a house. That's your kid's college fund. Gone. Paid to a fund manager who probably didn't even beat the market. Reason 2, the scoreboard doesn't lie. 92% of large-cap fund managers underperformed the S&P 500 over a 15-year period. 92%. And here's the real kicker. The 8% who did beat the market? There's no reliable way to identify them in advance. Past performance does not predict future results. That's not just a legal disclaimer. It's a statistical fact. So you're not just picking stocks. You're gambling on which expert will get lucky. Reason 3. Index funds protect you from your own emotions. When the market crashes, and it will crash, every instinct in your body screams, sell, get out, save yourself. But study after study shows that the investors who perform the worst are the ones who panic sell during a downturn and then miss the recovery. The boring index fund investor who does nothing during a crash, they almost always come out ahead. The hardest part of investing isn't picking the right stock. It's sitting still when everything around you is on fire. Reason 4. History is on your side. The S&P 500 has been around since 1957. In that time, it has survived Black Monday, the dot-com bubble, the 2008 financial crisis, a global pandemic. And it's still delivered an average annual return of about 10.5%. But over any 20-year period in the history of the S&P 500, the return has been positive. Every single time. When you buy an index fund, you're betting on the entire economy growing over time. Now, when people say index fund, they usually mean an S&P 500 fund. But there are actually many types of index funds, each tracking a different slice of the market. Let me walk you through the most common ones. First, total U.S. stock market index funds. These don't just track the top 500 companies. They track basically the entire American stock market. Around 4,000 companies, from the biggest giants to small startups. A popular example is VTI, the Vanguard Total Stock Market ETF. This is as diversified as it gets within the U.S. Second, international index funds. These track companies outside the United States, in Europe, Asia, Australia, and other markets. Adding international exposure means you're not putting all your eggs in one country's basket. A common pick is VXUS. Third, bond index funds. These track bonds instead of stocks. Bonds are generally less volatile. They don't swing as wildly, but they also return less over time. They act as a cushion in your portfolio. BND is a popular option here. And finally, sector-specific index funds. These track only one industry, like technology, healthcare, or real estate. QQQ, for example, tracks the NASDAQ 100, which is heavily tech-focused. For most beginners, I'd recommend starting with a broad market fund and only adding sector funds later once you know what you're doing. Now you might have heard 2 terms used almost interchangeably: index mutual funds and index ETFs. They're very similar, but there are a few differences worth knowing. An index mutual fund is priced once a day at the end of the trading day. Some require a minimum investment of a few $1,000s. An index ETF, exchange-traded fund, trades in real time, just like a regular stock. You can buy as little as one share, and the fees are often a fraction lower. For most beginners, either one works perfectly fine. If you want automatic monthly investments, mutual funds make it slightly easier. If you want flexibility and the lowest possible fees, ETFs are great. Honestly, the difference between the two is so small that the worst thing you can do is spend weeks debating which one to pick. That time would be much better spent actually investing. Pick one. Start. You can always adjust later. Alright, enough theory. Let's walk through exactly how you buy your first index fund, step by step. This is easier than ordering food online. I promise. Step 1. Open a brokerage account. A brokerage account is just an account that allows you to buy investments. Think of it as the online shopping cart for stocks and funds. Fidelity, Charles Schwab, and Vanguard are 3 of the most trusted options. They all have 0 minimums and 0 commissions for index funds and ETFs. Opening an account takes about 10 minutes. You'll need your name, address, social security number, and a linked bank account. Step 2. Deposit money. Transfer funds from your bank account to your new brokerage account. This usually takes 1 to 3 business days. And don't feel like you need a big amount to start. $50 is fine. $100 is fine. The amount matters way less than the habit of doing it consistently. Step 3. Search for the index fund you want. In the search bar of your brokerage, type the ticker symbol. For example, VLO, that's the Vanguard S&P 500 ETF, or VTI for the total market. If you opened an account with Fidelity, you might choose FXAX. They all do essentially the same thing. Pick the one that matches your brokerage. Step 4. Buy. Select how many shares you want. Even one is great. And hit the buy button. That's it. Congratulations. You just bought a tiny piece of 500 of the best companies in America. You're now an investor. The whole process can be done in a single afternoon. Now here's the part most financial videos skip. Buying an index fund once is great, but the real magic happens when you do it consistently. Month after month, year after year. This is called dollar cost averaging, and it's one of the most powerful concepts in investing. Here's how it works. Let's say you invest $300 every single month, no matter what the market is doing. When the market is high, your $300 buys fewer shares. When the market drops, your $300 buys more shares. Over time, this averages out your purchase price, and it means you actually benefit from market dips. When your favorite store has a sale, you don't panic and run away. You buy more. Dollar cost averaging does the same thing with stocks. Drops become discounts. Let me show you what $300 a month looks like over time. After 5 years, you've put in $18,000, grown to about $23,000. Nice, but not life-changing. After 10 years, $36,000 invested. Now worth around $61,000. After 20 years, $72,000 invested, worth over $200,000. And after 30 years, you've invested a total of $108,000. But your portfolio is worth over $600,000. More than $500,000 in pure growth. From $300 a month. That's not magic. That's compound interest plus consistency plus time. The 3 most powerful forces in personal finance, working together. Now I know some of you still have doubts. Let me address the 3 most common objections I hear. Objection 1. Is 10% realistic? Yes, but with a huge caveat. 10% is the average over long periods. In any given year, the market might be up 20 or down 15%.
It's a bumpy ride.
But zoom out over 20 or 30 years, and the average is around 10.5%. If you need this money in 2 years, an index fund is probably not the right place. Objection 2. What if it crashes right after I buy? Then you got your shares on sale. Seriously, if you're investing for the long term, a crash in year 1 is actually a gift. You're buying more shares at lower prices. The only scenario where a crash truly hurts you is if you panic sell at the bottom. The market beats timing the market. Every time. Objection 3. But index funds are so boring. Yes, they are. That's the entire point. Exciting investments make great stories. Boring investments make great retirements. The person who put money into a simple index fund every month and forgot about it ended up wealthier than 90% of people who tried to be clever. Let's come back to where we started. A room full of the smartest financial minds in the world, and a regular person in pajamas with a phone. The pros spent their careers trying to outsmart the market. The regular person just bought the whole market and went on with their life. And after 30 years, the regular person came out ahead. You don't need to be the smartest investor. You just need one boring index fund, a consistent monthly contribution, and the patience to let time do its thing. Here's your cheat sheet. An index fund tracks an entire market index. It has lower fees, historically better returns, and way less stress. You buy it through a brokerage account. You add to it every month. The most boring investment on the planet is also the most powerful one. If this made money make a little more sense, smash that like button. Subscribe if you haven't already, and share this with someone who needs to hear it. It helps more than you think. I'll see you in the next one.